The Instability of Stability, Hyman Minsky and the Economics of Financial Crisis. Hyman Minsky's economics begins with a deceptively simple idea. Capitalism does not necessarily become unstable because something goes wrong. Sometimes it becomes unstable because things go right for too long. This was the central insight behind Minsky's financial instability hypothesis. Unlike economic theories that tend to treat financial crises as external disturbances, unexpected shocks that knock an otherwise stable economy off course, Minsky argued that instability can be generated from within the normal operation of capitalism itself. Periods of prosperity change the behavior of borrowers, lenders, investors, and financial institutions. The very success of an economy can gradually transform its financial structure until the system becomes increasingly fragile. Minsky was deeply influenced by John Maynard Keynes, but he believed that Keynes's analysis of capitalism had not been taken far enough. For Minsky, you could not understand a capitalist economy by looking only at production, employment, consumption, and prices. You also had to look at balance sheets, who owes money to whom, how those debts will be paid, what assets are being used as collateral, and what assumptions are being made about the future. Every economic transaction involving credit creates a financial relationship. One person's asset is another person's liability. A business borrowing money creates a debt that must eventually be serviced. A bank making a loan creates an asset for itself and a liability for the borrower. As long as the expected income is sufficient to service these obligations, the financial system appears healthy. But expectations change. Imagine an economy recovering from a major recession. Banks have recently experienced failures and defaults, so they are cautious. Businesses are reluctant to borrow. Investors demand substantial returns before accepting risk. Everyone remembers what happened during the last crisis. Then the economy begins to recover. Businesses become profitable. Employment rises. Asset prices increase. Defaults remain low. The memories of the previous crisis gradually fade. A loan that once seemed dangerous begins to look reasonable. An investment that once appeared speculative begins to look conservative. Banks discover that lending money is profitable, while businesses discover that borrowing money can accelerate their expansion. Confidence grows, and as confidence grows, the financial system begins to change. Minsky described three broad types of financial positions: hedge finance, speculative finance, and Ponzi finance. Under hedge finance, a borrower can generate enough income to pay both the interest and the principal on the debt. The financial position is relatively conservative. Under speculative finance, the borrower can pay the interest but cannot necessarily repay the principal from current income. The debt, therefore, has to be refinanced or rolled over. Under Ponzi finance, the borrower's income is insufficient even to cover the full cost of servicing the debt. The financial position depends upon rising asset prices, refinancing, or obtaining additional credit. The important point is that Minsky did not imagine an economy jumping suddenly from safety into insanity. The transition can happen gradually. A successful economy encourages people to become more optimistic. Optimism encourages greater borrowing. Greater borrowing increases spending and investment. Increased spending produces income for someone else, while successful investment can increase profits and asset values. Rising asset values provide additional collateral, allowing still more borrowing. The system begins to validate the behavior that is making it increasingly fragile. This is the heart of the Minsky paradox. Stability can become destabilizing. When an economy experiences a long period without a serious financial crisis, people naturally begin to believe that the conditions producing stability will continue. Banks become less afraid of default. Investors become more comfortable with leverage. Businesses become more willing to borrow. Financial institutions develop increasingly sophisticated methods for extending credit. The absence of crisis becomes evidence in people's minds that crisis is unlikely. But the financial system has changed precisely because everyone has become more confident. Eventually, the economy may reach a point where asset prices and debt depend upon assumptions that cannot all be satisfied simultaneously. The system has become dependent upon continual refinancing and continually rising asset values. Then something changes. It does not necessarily have to be a dramatic event. Interest rates may rise, an asset bubble may stop expanding, a major borrower may default. Investors may simply become less optimistic. What matters is that the expectation of ever-rising asset prices is interrupted. Once that happens, financial relationships that previously appeared perfectly manageable can suddenly become dangerous. A borrower who planned to refinance a loan discovers that lenders are no longer willing to provide the necessary credit. An investor who depended upon rising prices begins selling. Falling prices reduce the value of collateral. Banks become more cautious. Credit contracts. More borrowers are forced to sell assets. And because everyone is connected through financial obligations, one person's attempt to become safer can make the entire system less safe. This is the phenomenon later associated with the term Minsky moment, the point at which a financial system's accumulated fragility suddenly becomes visible. The important thing, however, is that the Minsky moment is not the beginning of the problem. It is the moment when a problem that has been developing for years becomes impossible to ignore. The crash is therefore the final stage of a much longer process. Minsky's analysis also gives banks a much more important role than they receive in simple economic models. Banks are not merely passive intermediaries moving pre-existing money from savers to borrowers. They actively create and restructure financial commitments. They respond to competition, profit opportunities, regulation, and changing perceptions of risk. During a boom, a bank that refuses to lend may lose customers to a competing institution that is willing to take greater risks. Consequently, financial institutions can be pushed toward increasingly aggressive lending simply because everyone else is doing it. This creates another Minsky feedback loop. Successful lending produces profits. Profits encourage more lending. More lending increases spending and asset prices. Rising asset prices make borrowers appear safer. Their apparent safety encourages still more lending. Eventually, the financial system can begin interpreting its own success as proof that its increasing risk is actually safe. Minsky therefore offers a powerful way of understanding financial bubbles without reducing them to simple irrationality. Individual participants do not necessarily have to be stupid or irrational. They can make decisions that are perfectly understandable given the information available to them. The problem is that millions of individually reasonable decisions can interact to produce a collectively unstable system. This is one of the most profound aspects of Minsky's economics. Financial instability is not necessarily caused by irrational people behaving irrationally. It can emerge from rational behavior operating inside an evolving financial structure. Government and central banks therefore become crucial in Minsky's system. Minsky believed that capitalism required institutions capable of preventing financial instability from becoming a complete economic collapse. The central bank could act as a lender of last resort, providing liquidity when private financial institutions became unwilling or unable to lend. Government fiscal policy could support incomes and demand when private investment collapsed. These institutions could prevent a financial crisis from turning into another Great Depression. But even here, Minsky saw another paradox. If the government and central banks successfully rescue the financial system, the rescue itself can influence future behavior. Financial institutions may begin to believe that the authorities will intervene again during the next crisis. The memory of previous disasters fades. Risk-taking gradually increases. The safety net can therefore become part of the next cycle of instability. This is why Minsky's economics is ultimately more than a theory of financial crashes. It is a theory of capitalism as a constantly evolving financial system. Capitalism creates profits. Profits encourage investment. Investment creates income. Credit allows investment to expand beyond existing savings. Rising asset prices create collateral. Collateral allows additional borrowing. Additional borrowing pushes asset prices still higher. Confidence increases. Financial standards loosen. Leverage grows. And eventually the financial structure becomes dependent upon the continuation of the very conditions that created it. The remarkable thing about Minsky is that he does not describe this as an accident. He describes it as a tendency. Capitalism contains mechanisms that generate its own periods of stability, but those periods of stability change human expectations and financial behavior. The longer stability persists, the more aggressively people may exploit it. The financial system therefore gradually moves from conservative structures toward increasingly speculative ones. until eventually the system discovers that stability was never guaranteed. Minsky's deepest lesson is consequently not simply that debt causes financial crises. Debt is not inherently destructive. Credit is one of the mechanisms through which capitalism expands. The danger comes from the transformation of the financial structure itself, from a system in which debts can comfortably be serviced through ordinary income into one increasingly dependent upon refinancing, rising asset prices, and continued optimism. The crisis is what happens when that optimism runs into reality. Minsky therefore forces us to look at capitalism differently. Instead of asking only why an economy crashes, we have to ask what happens during the years before the crash. Who became more leveraged? Which institutions became more confident? What assumptions became accepted as normal? How much of the economy came to depend upon continuously rising asset prices? And how did yesterday's successful decisions alter today's financial system? The answer to those questions is the real Minsky story. A financial crisis does not necessarily begin when the bubble bursts. It may begin much earlier, during the long, prosperous period when everyone becomes convinced the bubble isn't a bubble at all.